Well, good afternoon, everybody. Welcome to our webinar. I'm delighted to be joined this afternoon by our partner, Alex Kossoff. Welcome, Alex. Alex is partner and head of accounts at Grunberg. He's also the training partner. As you can see, our webinar is entitled Get Set for 2021, and we look forward to Alex outlining a 5-step plan for the year ahead. We are going to have a live Q&A session at the end of this webinar. So if you're familiar with Zoom, please click on the Q&A button on your toolbar if you'd like to ask any questions. That will enable us to see them, and we'll try and answer as many of them live at the end of the session as we possibly can. We are also recording this webinar, so this will be made available on the Grunberg website later on today. And for everybody attending, we'll also drop out an email to let you know that the on-demand version is available in case you want to recap on any of the points that Alex has made. So I'll come back at the end to help field the questions, but in the meantime, I will hand over to you, Alex.
Thanks, Jo. Appreciate that intro, and thanks everyone for joining. It's lovely to have you here. So what I'm going to do is turn my camera off and we will start talking about a 5-step plan for 2021. So this was born effectively out of conversations and observations that we had with our clients throughout 2020. And one of the things that was a common theme for us was the challenges that businesses have faced during that time, and effectively those that have carried on into 2021, albeit we're only in the first week of Feb. So first of all, we're still in a not so new lockdown. Whilst the fears of people working from home that many businesses had at March last year still aren't as prevalent, they are certainly a consideration and have and will continue to have an impact on business. Some of the other challenges that we're facing at the moment, we've got new rules post-Brexit. Now, Brexit almost flew under the radar under the guise of COVID. And whilst this isn't a discussion on Brexit, the merits and changes to VAT, we certainly need to consider that when looking at planning for 2021, because it will have an impact on business. As with any crisis or change in the economy's structure or status, cash is always important. So looking at cash flow and being able to plan that out through 2021 is important, and especially in the context of a weakened economy globally. Now, you don't have to trade globally to actually be affected by this, but it's certainly something that you need to consider because it will impact services, goods that you provide to your customers. And to start with, I think businesses really need to look at financial health. And in order to do this, there are various tools and things that you need to look at. And what we've done is we've tried to, or I have tried to highlight some of those issues, and we'll go through them during the presentation. But the most important thing here is that whilst it's true a review of past performance is important, it's also equally important to look towards the future, because in doing so, you'll be able to rebuild and recover better from really what's undoubtedly been an unprecedented period. And in planning for the future, you'll certainly be able to make use of opportunities that might arise. Now, in order to do all of these things, I'm going to cover 5 areas that I think if you were to get a good handle on these, you'll be able to be in a position to pivot your business in the ever-changing world. And sort of the headline things we're going to talk about are implementing real-time data, looking at management accounts and why they're important, cash management, so cash flows, cash forecasting. We'll look a bit at pricing, key performance indicators or KPI, but also setting your business up to be flexible and being able to pivot income streams or costs so that you're really maximizing the profits your business might make. So turning to the implementation of real-time data, the world has constantly been changing, and that's really highlighted by the advancement of financial technology, and in particular cloud accounting. And we've been, as a firm, advocating and actively moving to clients to systems where real-time data is available, and have been doing so for a number of years. We partnered up with Xero, who are one of the main players, and whilst I could plug Xero endlessly, there are lots of other softwares out there that provide similar benefits. It's not imperative that you were to move to Xero, but a look at these new types of softwares away from the traditional Sage and QuickBooks Desktop is definitely something that you need to do if you really want to make your business more agile. The benefit of these software, or various softwares, is the fact that you have access to real-time accounting data. Now, Xero did some really interesting research recently, which said that 45% of business owners said advice and information from their accountant was more important than ever. 63% said the systems employed by their accountant had been essential, whilst a third said that the pandemic led their accountant to adopt new forms of cloud-based technology. And in essence, I suppose what this is summing up is that by using and utilizing new forms of software and systems, businesses have been able to react positively to the ever increasing amounts of legislation and knocks to the economy that we've had throughout the COVID process. Real-time accounting gives various elements to a business owner like yourselves. First up, it gives you an ability to review your profit and loss account in real time. And businesses have often seen this as almost the most significant benefit to real-time accounting data, because it's the most accurate way or quickest way to identify whether or not you're going in the right direction. And by using software that's predominantly in the cloud, you're able to access it anywhere. It gives you the ability to automate more of the process, churn through things at a faster rate, but also you can compare different periods of data, all without having to create cumbersome spreadsheets or make notes using various different documents that you've collated over the years. This, coupled with the fact that you don't have to wait to a month end or a quarter end when your VAT return's done, or worse still, 9 months after a year end to see how well your company's doing. You can have this data, if set up correctly, 24 hours a day. And the benefit of that is it will enable you to spot trends in your business, either positive or negative, and act on them before they become potentially an issue, or exploit them if there's something that is helping the business move in the right direction. And more so, at the moment, you can instantly see the impact that changes that you make have on the business. A good example of this is if you know that you're selling something and it's working well for you, and you receive the most amount of orders on it, it's not necessarily the most profitable. So by accessing this data in real time, you're able to assess and monitor whether or not things are priced correctly, and almost focus your energies on the things that are doing well for the business. Now, we talk about systems and softwares, and most of these are new to people. So the implementation of them could be daunting. Totally understand that. So there are a few things to bear in mind before you jump into bed with one of these new systems. But my suggestions would be start small. Don't try and implement all of the potential things out there all in one go. Start with the easy wins. So for example, most or all of these systems will enable you to link your bank account. Now, instantly that enables you to analyze, or the software to analyze the transactions that are going through your bank to see the impact they're having on your business. And once you're comfortable with that, you can then start expanding on the sources of data that feed into the software package. And in doing so, you effectively are building a central database of information and data where you are allowing AI and potentially professionals to be able to analyze this and help you make quick, snappy decisions to ensure that the business is moving forward in the right way. The most important thing, though, is that once you've set this up, if you do it on your own, there are a plethora of apps that can be added on and things that you can change within the system in order to improve the reporting of it. I would suggest seeking advice. We've got years of experience in this, and I think 99% of the clients that we service from a full accounting function use some type of online software. By seeking that advice, you can ensure that the software and the information you're getting is of the most, it is extremely relevant, but also accurate at the same time. So from this, one of the main things that you get from using this are management accounts. Now, management accounts are effectively reports that can provide vital insights into a business, and they're underutilized by a lot of smaller companies. Whilst many business owners make full use of the financial reports to get an idea of the business, fewer invest time and money into the management accounts regularly. So whilst they may get a picture at the end of a year, they don't have a full grasp of what's actually happening throughout. What are management accounts really, and why are they important? Well, I've touched on why they're important, but they can provide insights into a whole host of areas, and we'll get onto what a report should contain. But by reviewing them and using them, you get the ability to compare performance to previous periods. You can try and spot trends, which we've discussed already, and you can get computers and AI to analyze things that maybe you weren't able to do so before. And these management accounts or management reports that come out of the software can be tweaked in such a way that you are getting things like regular access to KPIs, and we'll come on to KPIs a bit later. But again, it just helps build this, this ability for you to make decisions in your business. Now, there are no strategic or there are no set reports that need to go in a set of management accounts. It's not like a set of year-end accounts that are governed by legislation. They can include anything that is relevant to you. So what I would expect to see, and again, this isn't exhaustive, but at the top of the report, you'd usually have an executive summary, which highlights some key performance indicators, which could be turnover or profitability. Next, you'd usually find a cash summary. In simple terms, a cash summary will show you what the bank balance was at the start, what's come in and what's gone out, and the bank balance at the end. And the reason that that's important is you can start using that to build into cash forecasts that will enable you to predict when you might have some black holes in relation to cash. And you're better able to plan for those rather than them being sprung upon you. We've already talked about the profit and loss account or the report, but this is usually a big part of the management accounts because it enables to show you whether or not ultimately the business is viable. You have the balance sheet that will enable you to quickly see whether or not the business is, again, viable, but also solvent. It's a key consideration at the end of any year. So by looking at your assets and liabilities, you can tell basically how healthy the business is. You'd also include things like age receivables and age payables, which show balances that are due to and from customers and suppliers. And usually these will be aged as well. So you can see if you've got any problems with credit control because age receivables have been hanging around for a while. And we'll come on to some ideas about how you can improve credit control a bit later on. But overall, these things give you a great snapshot into how the business is going. Now, as I said, one of the most important reports is the cash summary. And that ties into effectively cash management. So as businesses and you guys look to rebuild and recover from COVID, the coming weeks and months are going to be vital, and you need to manage good cash flow. To manage that effectively, you need to be able to forecast how you're going to perform. And a well-prepared forecast will effectively look at predicted sales, estimated costs, and indicate when cash is going to come in and go out. Now, these cash flow reports are extremely important. And as a minimum, you should be looking at somewhere between 30 and 90 days. But you should be hesitant to go too far further out because they're very subject to change and fluctuation, and they might not be able to take into account all of the changes in the economy. But it does give you a really good idea as to how you might fare in the coming months, especially given that some of you, I imagine, have taken out bounce back loans, C-bills, which are all going to be due for repayment possibly as early as May this year. And some of those are chunky amounts. The economy hasn't recovered fully, so you're going to need to be able to plan how you pay those back, because at the moment there's no discussion about those repayment periods or lack of repayment periods being kicked out any further. So to prepare a cash flow forecast, the first thing you need to do is prepare a sales forecast. And you effectively need to estimate what you expect to sell in the future, normally broken down by month. And whilst you might have some indicators on past performance, you also want to look at things that you know are going to happen in the future. So for example, if you've got a trade show that's coming up, you will be able to plug in some figures around that trade show based on how well you think you'll perform. But also you should look at the seasonality of your business. If you take the example of an ice cream van, great example, I love ice cream, but ice cream really only sells between May and September. So if you're doing this cash flow forecast for an ice cream van, your sales in that period are going to be higher than they are in the colder months. So you need to look at the varying factors that affect your business. The next stage will be looking at the profit and loss forecast. And this ultimately looks at the costs that are going to be incurred by the business. Big ones in there are salaries, usually. You'd also look at some furlough money that might be coming back in against those salary costs. I would avoid looking at tax now, but you would look at things like if you're planning on launching a new product or increasing your marketing spend with Google clicks. All of these things need to be included, but need to be included in the month they're going to be incurred, not the month that you're going to receive the invoice. And once you've done that, you can then estimate and include VAT. Now, VAT is quite complex, but in order to do that, you would look at the sales and you would know, I imagine the majority of you on the webinar have VAT applicable to their sales. So very simply, you'd take 20% of the sales, but in relation to costs, you'll need to exclude any of the costs that relate to salaries or pensions or national insurance because they don't attract VAT. And once we've got that, you're able then to effectively deduct steps 2 and 3 from step 1, and you come out with your cash flow forecast, and it will tell you whether or not you're cash positive or not. Now, it's all well and good looking at cash, but you need to be able to get cash in to be able to do that. And one of the things that most businesses in the SME arena have is being able to effectively manage credit control. So what I've done is I've tried to look at some steps that I see are issues with a lot of our clients and trying to give you some tidbits in order to be able to challenge those. Now, the first thing I would say is you would look at either creating if they don't exist or reviewing the procedures that you've currently got in place. And you need a really clear coordinated procedure for credit control, which has to be followed for every sale in its process. And the procedure should establish a realistic timescale or timetable, including the stages that need to be completed by various team members and needs to be based on the needs of the business. So once these elements are in place, you can then ensure that if you then ensure that you follow those processes, it will enable you to better chase in a more systematic way any amounts that are long outstanding. Now, a very simple thing you can do to improve credit control actually happens before you raise an invoice. You could do some research into new clients. It's really simple actually to do some credit checks on clients. You just need some trading name, registration number, address, some key contact details. And whilst it's no guarantee that these guys are going to pay when you actually raise the invoice, it's certainly going to allow you to make informed decisions as to whether or not, firstly, you take them on as a client, but more importantly, whether or not you change the credit terms that you have. You may have standard terms of payment within 30 days, but if you see that there's a client with a poor credit score, you could decrease those to 7 or 14 days so that you try and alleviate any potential late payment. You could go to the extreme of actually asking for payments up front. But all of that is based on or predicated on the information you get from doing some very simple searches. Now, my favorite one is actually fostering positive working relationships, because I think the more that you talk with your clients, the more you speak to them, the easier it is to talk about money and invoices at a later date. Especially in the service industry, it's not about just chasing for money. You have to be able to back that up with service. And in order to do that, you effectively have regular calls, touch points. It doesn't always have to be about credit, but in doing so, it makes it easier to have the conversation everyone hates having, which is effectively talking about money. One of the tools in your armory, which will be covered by the effective process or the procedures that you've got, is making sure that you're quick and accurate. So simple things, but make sure that you send invoices as soon as you've completed a service or fulfilled an order. Email them and don't send them by post. It's very easy to say that something's been lost in the post. Ensure it's addressed to the right person. Make sure there's no mistakes and confirm that the invoice has been received. All of these things keep you fresh in people's mind and enables you to improve the time in which it takes to get some money. The last 2 points, you can incentivize people to make payments earlier. Now you can build in discounts. You could offer discounts. Say, if you pay within 7 days rather than 30, you can receive a 5% discount. And whilst you might say, well, that means I'm receiving less money, you are receiving less money in real terms, but you are receiving that money quicker, number one. And number two, you could almost build it into your pricing to start with. So you're not actually losing anything out, but it gives the perception that the customer is receiving better value. And finally, probably the easiest thing here is make payments easier. There's never been more choice in the way that you can pay. I mean, I think I counted 7 or 8. There's backs, there's cards, there's chaps, there's Apple Pay, Google Pay, cash, check, online, PayPal. And the more of these options you have, the quicker you're going to get paid. I, for one, if I receive something on my phone, I would more than likely pay for it using my Apple Pay if I'm able to there and then, rather than waiting, logging onto my internet banking, setting up the payment, waiting for the code to come to my mobile phone. It's a faff. So the easier you make it, the more likely you are to be able to do it. And companies like PayPal have made it really easy for small businesses to be able to set these up really at a couple of keystrokes. So it's definitely something worth exploring. One of the key things that businesses continue to find, COVID or not, is whether or not they're pricing right. And many business owners already struggle with prices. And in a lot of cases, they set prices by competition. Some use time methodology and others stick the finger in the air and charge amounts arbitrarily. But none of the approaches give the perfect answer to everyone. And in the digital age, it's even more important to make sure that your pricing is right, because prices can so easily be reviewed. And by failing to grasp this, then businesses may unwittingly make their products or services less attractive. So if we look at some of the models or traditional models in pricing, there are some key lessons to take from this. I suppose the first is psychological pricing and importance of 9. And this is actually my favorite. It dates back to the 1800s. And effectively, it relies on strategic pricing of goods. Now, if you've gone to buy a car before, you'll notice that sticker prices usually are, if the car's value is 10,000, then the sticker price will be 9,999. And actually, studies have shown that psychologically, people feel like they're getting a bargain if it's 9,999 pounds rather than 10,000. And businesses are still using these tricks today, and amazingly, it works. And even though the price difference is negligible, irrational customers don't round up the price, and they perceive it to be cheaper than it is, and they're more inclined to buy it. And unbelievably, people perceive a price ending in the number 9 as better value and more cost effective, even actually in real terms if it's not. So there's some real psychology around this, and whilst I'm not a psychologist, it's definitely worth doing some research into that. One of the other ways that businesses can price is relative pricing, and this is increasingly scrutinized, especially in the digital age, because prices relative to the rest of the market can be key, especially with the emergence of price checking apps like Go Compare. So knowing how much to charge relates to several factors, and one of them has to be how much your competitor charges, even if that's not the driving force in setting the price. So constantly trying to charge less than a competitor will really squeeze your margins and potentially make them unsustainable, but almost always will result in a race to the bottom. So whilst relative pricing is important, it shouldn't be the be all and end all in making your decision. And actually, a lot of this is contextual. And sometimes a price is justified by lots of different factors, not just the service or product on offer. So you can look at some of the softer things in inverted commas. And a great example of this is people pay thousands for a Rolex, but they can buy a watch for £5 that will do exactly the same thing. And the same context applies online. Sometimes it can be down not just to price, but how your website looks or how easy it is to navigate, and some of the services that you offer alongside the price that someone's looking to buy. So you should also be looking at non-product service changes that will justify a higher price. And in doing so, you ensure that you're being different, and customers will rely on their own opinions of a product, which are entirely subjective, but they also rely on price, which is objective. And where prices are identical, it can complicate purchases. So, and lead to something called analysis paralysis, where actually everyone loses out. So if you're able to be different, you are effectively increasing your chances to make that final sale. So what's the common thread in relation to pricing? All the pricing strategies rely on the way the customers perceive the price. It means effectively adjusting your price could help increase sales and improve profitability if you price correctly. In today's modern marketplace, you can't sit back and just leave things static. You need to constantly review this. And whilst it's difficult, you need to be able to differentiate yourself from the rest of the market. Now, the final thing I want to cover with you guys is key performance indicators and KPIs. And there are a number of KPIs that you could use, and a lot of them, and the useful ones, are business specific. But some key ones that people have used in the past are things like revenue, income, concentration of revenue, profitability. But taking each as it comes, if you were to look at revenue, sales growth is one of the most basic barometers of success. But if your business isn't priced correctly and it's costing you more or too high a proportion of your revenue, then actually it's a misnomer that you're doing well if your revenue is increasing. As the old saying goes, turnover is vanity. So you need to look at turnover with a pinch of salt and in context. You should also look at your sources of income, basically what your revenue streams are. So I would look at what the revenue streams are, the revenue per client, and basically by that you can determine what the profitability of a revenue stream is, and try and hone and use your resources wisely to benefit from those more profitable sources. Revenue concentration is also a really key KPI. And in essence, what that does is it looks at how reliant you are on customers. So you could have a £100 million business, but if that's reliant on one customer, then you potentially have an issue. So if this is already the case, then I would really look at taking some action to diversify your client portfolio to protect yourself and your business. And actually, you would look at that in context of the profitability over time. So by tracking your expenses and income, you can compile reports, which we've already discussed, which can analyze the period and make sure that you're really targeting your efforts. The final KPI that might be worth looking at is working capital. And working capital is simply the money that helps you fund your day-to-day operating costs. And it can be used as a buffer to tide you over through things like COVID, but also help you capitalize on things and will give you hopefully some spare cash to be able to push the business forward. So that's me done. And I noticed that there's a couple of questions. I've given a lot of information and I'm happy to talk about this further on or offline. So I will hand back to Joe. And Joe, are you able to
Indeed.
facilitate from here? Thanks.
Thanks a lot, Alex. That was really, really interesting. I've got a couple of questions come in while you were chatting away. First one goes back to the section you covered on pricing, and got a question here from Jane, who's asked, can we do any kind of pricing scenario planning? So I guess this is what if examples, what if we reduce our prices by 10%? What if we increase our prices? And the effects on cash flow, etc. And are there any tools that can help with that?
Yeah, absolutely. So by using some of the softwares that we talked about, or I talked about at the start, you can effectively start building on or bolting on services. And there are some really great cash flow and forecasting apps that will enable you to do various what if scenarios, and you can almost find your break even or find if your turnover went up by 10%, what impact would that have on cash and profitability. So absolutely, that one of the key benefits to change in software will enable you to do this a lot easier.
Okay, and I've got a second question. If somebody's moving from, I guess they're saying here, from Sage to Xero, and I'm assuming the Sage might be a legacy Sage product rather than their cloud-based solution, what are the considerations that you need to think about, and how easy is it to switch products?
I mean, easy it's not the easiest thing to do, but it's certainly doable, and there are ways, and we can certainly facilitate things like that, to migrate data, sometimes up to 6 years old. And what would happen is that you would go through a process of taking the old data from the legacy software and effectively channel it through various other bits of software to get a product at the end that you can import into, say, Xero as an example, and ensure that your debtors, creditors, ledgers match up to where they were when you finish with the legacy. Whilst it's not an easy process, it can be done relatively quickly and shouldn't lead to much downtime in relation to your business and your accounting function.
And I guess that's something you can help with.
Absolutely, we can do it. We've been doing it for years.
Okay, thanks very much. Okay, well, that covers our time and our questions. Thanks very much, Alex. As I said at the beginning, this is being recorded, and we will make an on-demand version available on the website later on. Oh, actually, I've had one question pop up, Alex, so let's answer it, shall we? This is from Greg. So what would you say to those of us that are not tech savvy and are unsure of how to approach all the various options out there for financial reporting?
So I think the first thing is to speak to us. We've got a whole wealth of experience. As I mentioned right at the start, we've probably been doing this for 5 or 6 years now. It can be quite daunting. There's lots of information out there, but the simplest thing to do would be to first pick the accounting software that you wanted to use. And there's some key players out there. There's Xero, there's QuickBooks Online. Once you've done that, you can then look at how you would use tech going forward to be able to get some of the benefits that I mentioned. But speak to your contact with us, because we can absolutely guide you through it and talk about what might be useful and important for you. So really good question. It can be quite daunting, yes.
Thank you. Okay, right. The on-demand version will be available later. Thanks very much, Alex. Thank you to all those that attended, and we shall look forward to hopefully seeing you at one of our future webinars. Thank you very much.